inflation is up and employment is down. Will the Fed protect treasuries or jobs? Hello everyone and welcome to today's edition of Markets with Marcus. So today 2 sets of data were released that shed some light on 2 main worries about our economy, inflation and employment. Will our money keep its value? And how safe are our jobs? Now the numbers that were released today paint a mixed picture that puts the Fed a bit in a bind. The Consumer Price Index, the CPI for short, got up by 2.9% overall versus a year ago. That was in line with market expectations, but the highest since January of this year and clearly above the Fed target of 2%. The initial jobless claims came in at 263,000. That was higher than the market expectations of 236,000 and the last number of 237,000. This was also the highest new initial jobless claims since October 2021, when COVID was ending. So let's dive a bit deeper into the data, try to make sense of it all, and then think a bit what this might mean for the Fed and what they will do next week in the FOMC with our rates. So, Consumer Price Index, what was driving it? As I just said, the overall Consumer Price Index was up 2.9% versus a year ago. Now, as our regulars know, when you go deeper, statisticians like splitting the overall CPI, the inflation numbers, into a more stable core section and a less stable, more volatile section with food and energy. And if we separate those and just look at the core section first, so everything except food and energy, this core index was even a bit higher than the overall index at 3.1% versus the year ago. In this index, the main drivers of the price increases were used cars and trucks, up 6% for the year, medical care, up 4.2% for the year, and shelter, housing, up 3.6% for the year. Nothing was really cheaper than a year ago, at least not in these big categories that are the headline numbers. The closest was medical care commodities, fancy way of saying drugs and other medical supplies. They are pretty much unchanged at 0% versus a year ago. And apparel, clothing, that went up only by 0.2%. There is, however, despite the overall increase, no clear evidence yet of tariff-induced inflation either. So we'll need to see whether that will change in the next few months. So 3.1% for the core index. That means the food and energy index, which is more volatile, also less easily influenced by the Fed, must have come in a bit lower, and that's true. The reduction in the food and energy index was really driven by one big category, gasoline, the gas that we all put in our cars, was 6.6% cheaper than a year ago. Some other categories, however, were even up in this category as well, in the food and energy category. Piped gas, the gas that comes in a pipeline in our house to heat it, to cook, was up 13.8% for the year. Electricity was up 6.2%. And food away from home, eating out, was up 3.9%. So note that the Fed does not use the CPI, those numbers that we just discussed, directly. They prefer tracking the PCE, the personal consumption tracking index, the expenditures. That is similar though, so the overall story will probably usually be very close. Regardless of what index you look on, I think that the picture that we get, how I interpret it is, that there's clearly some price pressure in the system. And we may get more price pressure from the ongoing uncertainty and maybe the tariffs. And we've been mitigating a bit the effects by cheap energy. But again, you can't rely on that. Food, energy are notoriously volatile. So this price pressure in the system would call for the Fed to increase rates next week, at least if they really want to get to their target of 2% fast. So let's now look at the other data set that came in, the initial jobless claims. I had already said that the number was 263,000 versus market expectations of 236,000, 237,000 previously. So the highest since October 2021 when COVID was still raging. So you see in this chart that weekly initial claims were visibly spiking a bit. That's the numbers we just discussed. But it's not dramatic yet. Worse than expected, but not dramatic. So we can't really say whether that's a one-off or maybe the beginning of a trend. We don't know. There's also apparently still some after effects of the Texas floods from July in the system that pushed unemployment claims up in Texas. That may hopefully go away once that normalizes. And another data point that leads us to conclude that maybe it's not so bad is that it's different state by state. Some states have a worse picture, some a better picture, but at least it's not uniformly bad across the entire. So overall, the jobless claims, though, it's not getting better either, probably would argue for lowering rates in a tendency, especially when you take that together with the reduction, the revision of the numbers that we discussed yesterday, where we saw that the US employment in March was 900,000 positions lower than we had thought until recently. So clearly, they're more an argument for lowering rates. So what will the Fed do? They're not bad. The Fed has one tool, interest rates. They can go up, they can go down, they can keep them unchanged, but it's one tool. But they have two goals that they need to meet. One is inflation, so to keep price stability. As we just said, the Fed would probably be tempted to raise rates, slow the economy down, force people to get a bit cheaper, bring prices down, especially if they want to get to 2%. And the other goal, the unemployment, speaks for lower rates, as we just discussed, speed up the economy, create jobs. So that's a difficult balancing act, And there's no guidance how the Fed should deal with that. And there's also no clear textbook formula what you do in such a situation. So do they protect treasuries? Do they protect jobs? How does that work? If they don't get it right, the worst of all worlds, we get the dreaded stagflation, at least a little bit, where both unemployment and inflation are higher than we would wish. If they get it right, we probably get, hopefully at the end, full employment and stable prices. And both jobs and treasuries are approved. In Jackson Hole, a few weeks ago, Jerome Powell dropped heavy hints, as much directly as you can do it, but probably as a Fed governor, that he might prioritize employment over price stability. He wouldn't say directly that it also means that he may have to accept inflation that is maybe a bit higher than what you would normally get. Maybe it would stay a bit higher in the 3% range or so, instead of going back to 2% immediately. And when he says that he may prioritize employment over price stability, may help that the producer price index that we also discussed yesterday showed that from July to August, producer prices went even down slightly. So that may even give some justification to the argument of lowering rates to help employment, because maybe the price pressure in the pipeline is mitigated. And that seems to be exactly what markets are expecting. Markets are still expecting, as we've been saying for a while, a rate cut next week when the Fed meets in the FOMC, the Federal Open Market Committee. You saw it today again. The markets read today's numbers still as a confirmation of the path. All equity indices, all major equity indices were higher, clearly hoping for a rate cut that speeds up growth and the job employment. Whereas bond yields were stable to slightly lower, not a much, about a few basis points. and expecting clearly the rate cut as well. So people were buying bonds, driving rates, yields slightly lower. The 10-year ended at 4.01% and the 30-year at 4.65%. So that's the overall picture. Expectations still unchanged. If you are afraid of inflation, though, that it may stay a bit higher than you're comfortable with, maybe even go a bit more up, no one knows. We can't exclude it either. You should start thinking about inflation protection. Inflation protection is like an insurance policy. You need to buy it before you need it. It's too late to start buying inflation protection when inflation is already high. So if you're afraid, think about it now. And that will also be the topic of our member live this weekend, where we will be discussing tips and the upcoming auction of the 10-year tip that will be happening next. So thanks for joining me today. Drop me a note below with your comments or questions, and looking forward to seeing you soon again on Markets with Mark.